Mortgage rates have just dropped to their lowest point in almost 3 years, creating a new wave in the property market. This drop isn't just a number on paper. It's a real change that millions of potential homebuyers across the country can feel. With lower interest rates, a rare opportunity opens up for homebuyers, whether they're buying for the first time or looking to move into their dream home. On September 17, 2025, interest rates fell significantly, sparking new optimism in a market that has been challenging. Many people who were hesitant before are now rethinking their plans to buy a home. This isn't a small drop. Lower interest rates mean real savings every month, which can be used for other needs or to add to family savings. Now, homeownership is becoming more possible and affordable for families across the country, opening up new chances for many who could only dream before. The timing is important. This drop happened right before a big meeting of the Federal Reserve, which will discuss the direction of future economic policy. This highlights how closely linked the Federal Reserve's policies are to your mortgage rates. Every decision made at the national level can directly affect your personal finances. After years of rates being above 7%, this drop might be the turning point many have been waiting for. For those who have been patiently waiting and saving, this might be the moment you've hoped for. A chance to get a home with lower monthly payments. Let's talk more about why interest rates suddenly dropped, what it has to do with the Federal Reserve's policies and how their decisions affect the market, and what steps you should take next so you don't miss out on this golden opportunity. Mortgage interest rates are the cost you pay to borrow money for your home, and they're one of the most important things to think about when you're buying a house. Even small changes in interest rates can mean saving or losing thousands of dollars over the life of your loan. For example, on a $400,000 loan, dropping from 7% to 6% saves you almost $2,700 a month. That's over $32,000 a year. That's a huge saving you could use for other things. Most buyers choose a 30-year fixed-rate mortgage for stability because it gives them a steady monthly payment they can count on. But your actual interest rate depends on a few things like your credit score, how much money you put down, and your debt-to-income ratio. All these things affect how risky lenders think you are. The recent drop in rates lowers the bar for everyone, making it easier to qualify and buy a home. This is great news for first-time homebuyers. When rates are high, fewer people can afford to buy, which cools down the market. This can make home prices more stable. But when rates go down, affordability goes up for everyone, allowing more people to buy their dream homes. That's why this week's news is important for every homebuyer. Knowing interest rate trends can help you make better decisions. Understanding your interest rate is the first step to making a smart purchase. With the right information, you can get the best deal and save a lot of money in the long run. The average 30-year fixed mortgage rate just dropped 12 basis points in one day, hitting about 6.13%. This drop is pretty big, especially since just a few weeks ago, rates were still above 6.25%. This change was felt right away in the market, as many potential home buyers who were waiting are now starting to look again. This is the lowest it's been since late 2022, a big drop from the 7% plus rates we saw earlier this year. Compared to last year's big jump, this drop is a huge relief for many people who want to buy a home, especially young people who are just getting into the housing market for the first time. That move happened suddenly because investors started buying mortgage-backed securities as they expected the Federal Reserve to cut interest rates. Activity in the financial market went up, and experts think this trend could keep going if inflation stays under control and money policies remain helpful. It's not just 30-year loans. 15-year loans and government-backed loans also saw rates go down, which helps even more people. This means more choices for home buyers, whether they want shorter payment terms or rely on government support programs. Even refinancing rates got better, making this a good time for current homeowners to think about their options. Many homeowners who weren't interested in refinancing before are now starting to figure out their potential monthly savings. Even though we're not back to the super low rates of 2021, this is the most positive change in a few years. Many market watchers see this trend as an early sign that the housing market is getting better, and if rates keep dropping, home demand could jump again. This proves that high interest rates don't last forever, and opportunities can pop up quickly. For anyone who's been waiting for the right time, changes like this show how important it is to watch the market closely and be ready to make a move when a good chance comes along. The central bank doesn't set mortgage rates directly, but its policies spread through the economy and affect them. The central bank's main tool is the federal funds rate, which affects how much it costs for banks to borrow money and, indirectly, for you. Mortgage rates follow the yield on the 10-year government bond, which moves based on what investors think and signals from the central bank. When the central bank hints at easier policies, investors buy bonds, yields go down, and mortgage rates follow. The central bank also buys or sells bonds to manage interest rates. Buying them lowers rates, selling them raises rates. That's why every central bank meeting matters for your mortgage. This week's drop in rates is a classic buy on the rumor, sell on the news moment. With a 96% chance the Fed would cut rates, investors rushed to buy mortgage-backed securities before the official announcement. This demand pushed bond prices up and yields and mortgage rates down. But after the Fed acts, the market might change direction because the news is already priced in. We've seen this before. Rates drop before a Fed cut, then go up after the announcement. The lesson? The market moves on what people expect, not just what actually happens. Today's low rates might not stick around for long after the Fed makes its decision. Not all Fed rate cuts have the same impact on mortgages. Cuts during a recession usually push mortgage rates much lower, as investors look for safety in bonds. But when the economy is stable, like it is now, Fed cuts often have less of an effect. Last year, after several Fed cuts, mortgage rates barely moved or even went up. This shows that today's drop might be temporary, not the start of a long-term decline. History tells us, don't expect a big, lasting drop just because the Fed eases up. So what's next for mortgage rates after the Fed meeting? Experts are warning, don't expect another big drop. In fact, rates could even go up a bit as the market sells the news. The current low rates are likely a short-term dip, not a new normal. Most analysts agree, the super low rates we saw during the pandemic are probably gone for now. Projections suggest rates will stay around where they are now, with only small changes in the future. The key takeaway, this is a short-term chance, not a long-term trend. If you're ready, act fast. Waiting might mean you miss out. So what should you do right now? Get ready and act fast. Shop around, get offers from a few different lenders to save hundreds or even thousands each year. Boost your credit score and lower your debt-to-income ratio to get the best interest rates. Even small improvements can mean big savings over the life of your loan. Don't be afraid to negotiate, especially with developers or sellers. Ask about rate reductions or help with closing costs. The market is more balanced now, giving buyers more power to bargain. Being prepared and negotiating smartly can help you get a great deal. Take advantage of this chance while it lasts. This dip to a 3-year low is a rare chance for both buyers and homeowners. This window of opportunity might close soon, as history and experts suggest interest rates could go up after the Federal Reserve's announcement. For buyers, get your finances in order, find the best loan, and be ready to lock in a rate. For homeowners with high interest rates, now is the time to think about refinancing. The market is moving fast. Those who act quickly will benefit the most. Whether you're buying or refinancing, this is a moment of hope and chance. The door is open. Step through before it closes.